Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets. Miles and Tori are in the house. Miles, why don't you lead us off with prices this week?
Sure. Let's take a little look at what has happened in the precious metals and a couple adjacent market indicators over the last week since our recording last Wednesday. Gold currently sitting at $2,320, down about 1.6% off of the end of the day Wednesday after we finished up our recording last week. Silver also down a little bit at $27.25, down about 3.4%. Platinum solid move down to 902, down about 6.3%. And palladium just barely above 1,004, down 2.4%. On top of that, the S&P actually took a little bit of a bounce after about a 6% decline over the last couple of weeks. It's back up to 5,084. Up about 1.2% over the last week, and the dollar's pretty much flat. There's not a lot to talk there. I think it's down at 0.1%, sitting at 105.8. So most of the market's relatively stagnant this week. The number on platinum sounds pretty high, but the volatility's been so high, a couple percent up and down is not unreasonable. And looking to see if the dollar can catch up to those October highs. You know, the dollar has been rising here over the last couple weeks and seeing if it can break up into new territories, but we've got to get a couple points higher. So gold, moving back to where we like to start, had a nice run. You know, we made our sell in May and go away joke last week. Obviously, this is a pretty tumultuous year, guys, with elections here in the States, as well as, let's just say, shots being fired all over the globe at this moment. So it wasn't unreasonable to see this great run up in gold. Do we think it's over for the next couple of months? Are we going to get a little bit of a pullback, maybe some adjustment in the ratio between gold and silver? Let's chat about it. Where are you guys sitting?
Yeah, it's really tough to tell. You know, there are so many underlying fundamentals that push and pull on the gold price. Occasionally, gold will predict, right, Rob? I mean, it's one of those things, but mostly it reacts. For the most part, it's reacting to news. It's reacting to underlying fundamentals once the news comes out, whether that's fiscal policy, monetary policy, economic, whatever that is can actually drive it. But today's one of those examples that we've seen more of, or increased frequency in Treasury yields and the dollar and gold all being up on the same day. Usually that's not the case. With those other two up, usually gold would be down. And so then you start to look at those underlying fundamentals. We had a great listener question this week about could we be a little less myopic in a sense in terms of just focused on the metals and get more macro? Well, we could. You know, it wouldn't be Golden Rule Radio. Actually, that's very much what McIlvaney Weekly Commentary does each week. That comes out every Wednesday. So we have a handful of resources that we offer for free that you can sign up for to get automatic email notifications of on a weekly basis, including Golden Rule Radio. So if you go to our website at McIlvaney.com, I would say you'll get more than you want, and we're far from myopic corporately, right?
Right. Yeah, the weekly commentary, boy, it is exhaustively involved in big macro view, whereas we're just looking at the simple gold, silver, platinum, palladium, the dollar, the major indexes, support, resistance, moving averages, Fibonacci's. Yeah. We are going to stay focused that way.
Yeah, so we're going to look each week at the technical aspects, right? The charts.
The charts, the seasonal aspects, the fundamentals.
Yep. Yeah. The fundamentals is the other part. So what's moving the markets, call it news or what have you. But in order to back away, it becomes really macro. I mean, you've got debt, you've got deficit spending, you've got money supply, geopolitics, uncertainty or fear or market stability and predictability,
banking,
politics, banking, treasury
real
yields,
estate.
Real estate, absolutely.
Oil and gas.
Real rate of return, commodities prices versus macro equity cycles. All of that plays a role. Now, occasionally, again, we said it predicts, and gold can be the canary in the coal mine. And I think that's what the listener was getting to is what story is gold really telling? So, Miles, this is a really long answer that I didn't intend to go this way to your question. What do we see happening? Well, you have to predict in each of those categories as to what is going to move the price that week. And sometimes fear is the number one driver. that can settle. I'll tell you one thing that we talked about this week is that geopolitics is not a lasting fundamental driver of the gold price.
No.
So even though it has short-term cycles, much like what we saw with platinum and palladium when Russia invaded Ukraine, very short-lived spike, right? It's not going to carry that for long because either there's de-escalation or there's just numbing to the situation, and markets can stabilize around a condition. So anyway, Miles, tough to predict. With the ratio back up over 85-1, I would encourage people to not be afraid to be positioning here. I think some of what we've heard is some paralysis by analysis. They don't want to buy as the market is climbing and they start to overanalyze and they get stuck. Well, buy silver here then, because that's like buying gold at $1,900 an ounce with where the ratio is. Let the silver work for you in the short term. You can move it into gold later, and you will have saved $400 an ounce on your gold today by having done that. That's what we try to do with portfolios.
Right. And I would say the vaulted platform is really good for that, even though there's taxes involved from moving from one metal to another. It's something that the individual client completely controls. They can control their exit point and their entrance point on either side. Great platform to be in physical. It's not paper contracts. It's actual physical gold, physical silver.
Well, that's right. Let's say you're hedging your portfolio and the
Right.
wheels really do come off.
Right.
What good is 5 to 10% of your portfolio going to do you?
None.
None. What good is paper gold going to do you?
None.
Okay. So that's why we focus on what we focus on. And fundamentals, I mean, the stock market, we don't sit here and break that down either. It's a money supply barometer too. Gold is for you, I don't want to put words in your mouth, Rob, but you tend to look a lot at what money supply does to the gold price, right?
Oh,
The
yeah.
more dollars in circulation, the higher the price.
Direct effect.
Well, same thing with equities. So,
Sure.
we have to look at those fundamentals, and that is the sheer magnitude of dollars being created and pumped into the system. So let's go back to the charts, Miles, if you don't mind. We don't want to not recap here and do a weak dive and see where we are in terms of those support and resistance levels, and then we'll come back to some fundamentals to wrap it up.
So if you do want to take the longer view of gold, I mean, we're talking about a gold bull market that's up 130% now, starting back in 2016. And realistically, following just the kind of post-COVID era where we stopped at around 2,100 and put our floor in back in October of 2022, we're up 50% in 18 months, and the wheels haven't come off yet, or at least the average person doesn't realize they have. We're not getting the shimmy in the Cadillac quite yet. So we're still going to be looking at these markets as they ebb and flow up and down, but there's a couple things that we've talked about for years. One of my big arguments has always been the trend wins. You can have highs, you can have lows. Tori, you just alluded to this a second ago. You can have highs and lows that are caused by reaction to political and geopolitical events that cause the price to move faster towards the end goal it's going to anyway, or slower. I always say news speeds up or slows down the direction a market was going anyway. And with the inflation rate and the exponential growth of inflation that we've seen over the last 10, 20 years, obviously gold is playing catch up right now. Gold has not kept pace exactly with, say, M2 money supply. But when you lay those charts over top of each other, Rob, like we've done in months past, they look pretty similar. M2 is a pretty logarithmic line up over the course of decades. Gold has some periods where it extends above it or drops below it, but realistically, they do follow side by side. So when we look at these charts short term here, what we're looking for is opportunity to get involved with a clear trend. That's why we're looking at these prices on a week-to-week and month-to-month basis, because we want to be able to increase our positions in precious metals. So in doing so, let's zoom back in from that 3, 5, 7-year chart, and let's actually take a look at what gold's done over the last 6 months here. So we're now coming up from a bottom of around 1820. That's really where this gold price kicked off back in October last year, coming all the way up to over 2400 here just a week ago. If we're going to see a bit of a pullback here in the gold price, I would argue your best entry levels are going to be around 2220, 2220, down around 2150, and possibly 2080, which is kind of where the old highs were to begin with. So there's a couple little step back points we could see here over the summer that allow us to enter the gold price as it continues to move forward, because I don't want to lose the end goal that I see here of gold. Take this 2000 plus mark. I don't think people fully understand what those numbers could end up being when this is all said and done. When you factor in what inflation has done to the buying power of our country, and the fact that gold is just a stable valued asset, it's just an element we dig out of the ground. It's not like the stock market. Gold doesn't make anything. It's not building iPhones and selling them. It's not working off margin. It's just a thing you dig out of the ground that maintains value over time. So when you look at what gold has done compared to inflation, I don't think the average person really realizes where this market's going to go. And it's so reminiscent to me of what we were looking at in 2005, 2006, when we were watching gold slowly, quietly pushing back up to the old highs of like 800, which predate me in the industry. But Rob, I think you were definitely in the industry. I know you've told your story of the first time you ever went to go buy gold and you couldn't understand why you couldn't.
Right.
As gold was pushing into those previous all-time highs, kind of like we've recently pushed into and above the previous all-time high that we set back in 2011 of around 19 and change, 1980 or so.
1925, actually. Yep, I remember that.
I would argue the average person still doesn't care. So the question is, what is going to be that key wheels off takeaway moment where the average person watching CNN or Fox News at night goes, holy smokes, everybody's saying buy gold. What's the price going to be when the average person gets involved? 5,000 an ounce? 10,000 an ounce? I don't think it's till the end. So what we're trying to provide are those entry opportunities before we get there. Because you don't want to be on the back end of a market move like this. Because this isn't just like, I want to jump on GameStop, or I'd like to make some money with Bitcoin. This is purchasing power. This is the ability to buy groceries, gasoline, pay your bills, and pay your mortgage. That's what inflation destroys.
Well, that's also why these prices were baked in the cake, because we were getting the inflation numbers 2 years ago. And we're screaming from the rooftop saying, look, anything under 2,000 an ounce is ridiculous. You need to be buying. And again, on this show, we would say, here are the dips, here are the pullback points where you would add to ounces. And remember, 4 times we had to try to break through 2,080. I mean, anything up to 2,080, and people were thinking, oh, this is an all-time high.
Right, it'll never get through.
Right. Now, we don't think we're going to see it again.
I really think 2220 is probably the right number or close to that. And again, I want to reiterate, why do people buy gold? They're either buying it because they have something to buy food and gasoline with, pay the mortgage, etc., or they do see it as an investment. Now, we have listeners that are trading the metals in and out. That's the only reason why a stockbroker would even consider owning gold. Otherwise, it's a pet rock. To them, you own it, it goes up, you sell it, get into something else. But the main reason our listeners are into gold and silver is because they have lost faith in the system, period. They don't trust the currency. They don't trust the banks. They don't trust Wall Street. They don't trust Washington. And so to them, it's a place to park their capital until we can see what the road ahead is going to be like, or to await the ratio between gold and a 3 and 2 house, a 3-bedroom, 2-bath house, or gold versus the Dow Jones Industrial Average. And we provide those historic ratios for people that want to look, well, when is a good time to be into gold? When would be a good time to reallocate either to real estate or equities or bonds, what have you. But another main reason why people buy gold is a legacy investment, to pass on their wealth to the next or future generations. And so those are the 4 main reasons people are in with us anyway. And we recognize all 4 of those. But looking back on when I started, when I bought gold in 1973, it was $100 an ounce. And my father looked at me and said, Robert, are you sure you know what you're doing? It was $35 an ounce 2 years ago. It's tripled. Are you making a mistake? And my father was not a stupid man. He actually graduated from Harvard back when Harvard was a legitimate university.
Remember, we're apolitical.
Right. Sorry.
Just kidding.
But, but a new car back in 1973, you could get a new car for $2,500, $3,000, $3,500, get you a decent car.
30 ounces of gold?
Yeah. So looking back, it was Vietnam. It was Watergate. It was inflation. Gasoline was $1 a gallon. It was 35 cents just 2 years before. There were assassinations. There were race riots. Things were very similar in 73. Move forward to where we are now. We're not that much different. And I can tell you what happened to gold. By the time I graduated from my mother's college in 1979, gold hit 850. And like Miles was just saying, we're trying to show entry points before the mania. We're not at the mania, but I can promise you we are going towards a mania.
And I'm glad you said that because you even brought up that first triple. Miles, do you remember when we did that chart on the number of times, the cycles of a 300% increase in the gold price going back to 1973? And that's the way you kind of started the show, talking about the low in end of 2015 at $1,050 an ounce. We're up 130%. That's nothing.
That's
right?
not a triple.
If you want me to tell you where the price tops out, it's going to be at least $3,100. So,
and I don't even have to take my boots off to do that kind of math.
yeah, that's right. So, we should repurpose that chart, Miles, from about 6 months ago because it's timely and it'll encourage the current sideliner, if you will, to go ahead and step in here. Again, on any pullback, you don't have to buy it at the top. But if we come down to 2220, you're saving 10% from the high.
Yeah.
Why wouldn't you want to save 10% even though you know it's going to go to 3,000? You're happy buying here anyway, and especially if you're picking up some silver and turning it to gold later. So that's what we're going to try to help you.
Yeah, the best way to approach this is just to start buying every week or every other week. I've got several clients that are just now on the platform adding, we did some this week, we're going to do some next week or the week after, and we're just going to keep chipping away at it because it could actually drop another $100 from here just like it already has. We don't know.
And that's just nothing. Percentage-wise, it's nothing.
Right.
Right? But $100 is $100
Sure.
if you're buying an ounce. So let's go for it. But yeah, I appreciate that. I appreciate the long-term outlook and things that aren't changing are the spending, the debt, the money supply growth, the debasement of the currency.
That's exponential.
It is. And it's like death and taxes. It's guaranteed. It's part of the Federal Reserve policy.
Yeah, talk about being baked in the cake. And the growth is exponential.
There you go. And unfortunately, you can't get a real rate of return with interest rates at 5% when the real inflation is over 8%.
Yeah.
That means you're losing 3% a year. Well, guess what gold's doing? It's outperforming the 8. So that second item you brought up as an investment tool, well, it is. It's going to return better than the bond yields. Bond yields, yeah, you can go get 4%, 5% return. Look at what gold is returning. And so it brings balance to that investment portfolio, but make sure it's an adequate percentage.
But it's really hard for people if they've got 500 or 700,000 in money market accounts and bank accounts. They can look at that number and they know exactly what they have. And I've run into this with clients, and they feel a sense of security knowing how much money they have. And it is hard for them to go and put a third of that into gold. Like, well, I don't know what it's worth. It's so volatile. But over time, it's amazing.
Yeah, here's a quick exercise. When you were looking at $50 an ounce, okay, you mentioned 100, you mentioned 35. When our company started, it was $50 per coin, right? $50 an ounce, you did $50,000, you got 1,000 ounces of gold. And without any maintenance, without anything, it just sits there for those 50 years, and it's now worth $2.4 million, your 1,000 ounces of gold. That's a pretty good return for something that's zero maintenance, zero risk. It's private. It's off the radar.
Not bad for a pet rock, huh?
Yeah, there you go.
Well, I think a good argument for that guy you're talking about who's sitting with that big chunk of money in the savings account is don't look at the number, look what it translates into. Because you can look over here at Forbes, the average family of four is now spending between $15,000 and $20,000 a year just on groceries, between $1,100 and $1,700 a month. And according to the Motley Fool, that's up 13 to 15% a year over the last couple of years over and over again. So think in terms of what that translates into. That's how most of us think anyway. How many hours do I have to work to afford that Hawaii vacation? Well, it's not the Hawaii vacation anymore. It's how many hours do I have to work just to feed my kids this week? And I think you'll start to see the value of owning assets that over time are going to average and protect you against things like inflation. So you have your equity position or your real estate, you have your investments for growth, not preservation. You have your preservation assets for preservation. And you have a little bit of liquidity for that spending you need on a short-term basis. But realistically, guys, I ain't keeping as much in the checking and savings account as I did 5-6 years ago. And I don't think you guys are either.
No.
That's what I use things like our vaulted account for. I don't mind buying and selling a little bit of gold when I need to cover expenses. I used to keep that money in a savings account. I don't do that anymore because I don't trust that system. It's not because I'm paranoid about the banking collapse, even though that's probably is going to happen again, like it has in the past. It's not because I'm concerned about the CBDC, because frankly, the CBDC is coming, whether we like it or not. There will be some type of digital currency, and we're all going to have to learn how to navigate around it. Those are great reasons to do it, but those aren't the reasons for me. Those are adjacent reasons. The real reason I do it is because every day my money is sitting in my savings account, I'm losing purchasing power. So that's all that matters to me. So that's about as big picture as I can get, is why do I own gold in the first place? There's why. Why do I care about the short-term market moves? So I can buy more gold. It's not that complicated. That's how I look at it. I think I'm in good company in saying that as well. I think that's going to do it this week for Golden Rule Radio. As always, we appreciate you guys stopping by. If you liked what you heard, hit the YouTube buttons for us. That certainly helps us out a lot. You can swing by our website to find more info at McElvaney.com. We can be found on Facebook at McElvaney Financial. We're also on Twitter at ICA Gold. As always, you can give us a call to discuss your personal portfolio. We can be reached at 800-525-9556. Thanks for listening and have a great week.